Good afternoon and welcome to CFA Society Chicago's event entitled SPAC Investing, a deeper look at blank check companies. This programming is brought to you by our Education Advisory Group. I'm Chris Vincent, President and CEO of the Society. I believe you are all familiar with our event protocols, but just in case, a gentle reminder, they are: all attendees' mics will automatically be muted during the event. The event is being recorded. And please use the Q&A feature on your screen to ask a question of the panelists. Also, please note that our upcoming programming and our past recorded events are available on our website at www.cfachicago.org. And now let me introduce the moderator of this afternoon's discussion, Robert Hoffman. Robert is co-founder and managing partner for Larix Capital Partners, which is a group of family offices, accomplished investors, and business builders focused on direct, private investment opportunities. Prior to Larix, he served as Chief Investment Officer and Principal and Portfolio Manager, respectively, at two single-family offices in Chicago, where he was responsible for investments, portfolio construction, and risk management across multi-asset class portfolios. Joining Robert today on the panel are Jason Drajo, Head of Asset Allocation at UBS, James Graff, an Independent Director with Velodyne Litter and sponsor Graff Industrial Corp, and Nicholas Petruska, Executive Vice President and Chief Financial Officer at Hennessy Capital Acquisition Corp. And now, let me turn it over to our moderator, Bobby.
Thanks, Chris. And yeah, thanks for everyone who registered for the event today. We're really looking forward to it. We have, an awesome panel to discuss the topic, and it seems to be a hot topic. Registration, I was told, sold out and went to a wait list. So we're happy for the level of enthusiasm and participation in our events. So just to kind of kick it off, SPACs being a hot topic, 2020 is on track to be the highest volume year for IPOs since the heyday in 1999. And what's interesting is over half of the IPOs this year have actually been SPACs, special purpose acquisition companies. So it goes, it stands to reason that people want to know what these are. I started investing in SPACs in 2013 and have been involved since. Most of the people that I have talked to about the matter are entirely unaware that the SPAC market even exists. That isn't until this year. And this year, SPACs have really ascended into the mainstream in a major way. A lot of the popular stocks this year, DraftKings, Virgin Galactic, Nikola, have come to market through SPACs. So we put this panel together today to kind of explore the topic a little more in depth. I want to go ahead and introduce everyone a little more depth. We have Nick Petruska. He has been a sponsor on 4 SPACs over the last 8 years under the Hennessy Capital brand. He's currently Executive Vice President and Chief Financial Officer for Hennessy Capital Acquisition Corp. 4, which recently announced its business combination with Canoo, a mobility technology company serving the electronic vehicle market. And prior to SPACs, Nick was involved in private equity at CHS Capital, and before that was in investment banking at Morgan Stanley. Jim Graff is joining us. He's also a repeat SPAC sponsor. He's been involved with 5 SPACs over the last 10 years, including the 4 Eagle branded SPACs and his most recent Graff Industrial Corp, which completed its business combination with Velodyne Lidar, the world's leading LiDAR technology company. Prior to SPACs, Jim was involved in investment banking for 2 decades, at firms including Morgan Stanley, Smith Barney, Deutsche Bank, and Merrill Lynch. And finally, we have Jason Drajo, who is the head of asset allocation at UBS, where he's a member of the Chief Investment Office. Prior to joining UBS, Jason spent 9 years in research at Morgan Stanley, eventually becoming the firm's global cross-asset strategist. In October of this year, Jason and his team authored a paper on SPACs that was widely read, and it provides a lot of clarity, even to someone new to the topic. So we thought before we kick it off, the discussion today, we'd ask Jason to give us a little background on what SPACs are, a SPAC 101, if you will. So Jason, maybe you can take it from here.
All right, thank you, Bobby, and good afternoon, everyone. So I think that to set the context for the conversation that follows, I think it just helps to have some basics down, and we'll get into probably more the details of specific features as we progress. To think about SPACs, I guess there's kind of three basic questions I think you want to answer is, basically what are they? What do they do? And then what is sort of the governance structure for them? So what a SPAC is essentially it's a shell company that's created by a sponsor with the objective of raising capital to make an acquisition. It raises capital by doing an IPO, by going public. It's going to be listed on the New York Stock Exchange. It raises capital that goes into a trust, and then they have 2 years to make an acquisition. During that period of time, they will search for different targets. Private companies, usually in an area of some sort of expertise or area that they're kind of familiar with, and that's part of when they kind of create the SPAC, they kind of targeted, they've identified certain areas of companies they'd want to acquire. Once they make the acquisition, sometimes they actually then go out and raise additional capital through a PIPE, a private investment in public equity, to enhance the purchasing power, so they can maybe buy a bigger company than what the SPAC initially raised in terms of amount of capital. And just for context, of all the SPACs this year, the average amount raised by a SPAC IPO is around 350 million. And the biggest one was 4 billion, but the bulk of them are really less than 500 million. So once it makes that kind of, identifies the target, it can do the acquisition. Once the acquisition is complete, whatever the company is, and Bobby gives some examples of DraftKings, Virgin Galactic, the SPAC then basically takes that company public. So now really what's public is now this company. The SPAC would often change the name to that name of that company, change the ticker symbol. So if you're a SPAC investor, really now you don't own a SPAC anymore, you own shares in essentially this public company. Now, the key thing about sort of the SPAC structure is thinking about what you own as an investor and what does the sponsor own. When the SPAC does the IPO, you are getting units in the SPAC, which consist of shares plus warrants. The shares are typically priced at $10 per share. And with each share, you might get a warrant that allows you to buy, say, another half share or a third of a share, typically with a strike price of $11.50, so there's a bit of a premium, and a forced conversion price of $18. That's what happens when the IPO occurs. After about maybe 50 days, sometimes the warrants kind of separate, or you as an investor can sell them. So at some point in time, you can own the shares, you can own the warrant, or you can own either one of the two. You also have at some point sort of a redemption right. So once the acquisition target is identified, you can say, you can vote on it, or you can choose to sort of redeem or put back your shares to the SPAC sponsor to say, I want my money back, I don't approve of this merger, in which case you get your $10 per share back. That's kind of the payoff and then the profile. From a sponsor perspective, what they get is essentially 20% promote, which is a claim on the equity and the warrants. I guess the best analogy I can think of is sort of like a 20% carried interest for the private equity general partner in sort of a private equity fund. They only get paid and kind of get that if the SPAC actually makes that acquisition. If not, the SPAC is wound down, and essentially, the sort of some risk capital that was put into it to underwrite the SPAC to find an acquisition, that's kind of lost. So hopefully it gives you a bit of a sense of what the SPAC structure is, and we can kind of take the conversation from there. So I'll pass it back to you, Bobby.
That's great. So, I mean, it seems like what it boils down to is a SPAC's a vehicle that's intended to bring a company public. I guess, kind of the first question that comes to mind is like, why not just do a regular way IPO? What's the benefit of doing it, through a SPAC? So why do these SPACs exist? What are the merits? And Nick, is that one you can address?
Thanks, Bobby. Happy to. So I think one of the biggest benefits of going public through a SPAC, in my opinion, is the benefit of certainty. If you structure the transaction appropriately, I'd say the SPAC is really the only way to access the public markets with an execution certain transaction. And I always like to go into examples. And I think one of the best examples of this was the transaction with my third SPAC, Hennessy Capital Acquisition Corp. 3, and the company NRC Group, which was owned by the private equity firm at the time, JF Lehman. We closed that transaction in October of 2018. And the reason I think that's important is if you go and look back at kind of the first real period we saw of market volatility, post Great Recession was in that late Q4 2018 into early Q1 2019 time period. And if you look at October specifically, during that month, 100% of capital market transactions were pooled. When I say capital market transactions, it's not just IPOs, but all IPOs, all follow-on equity offerings, and actually every single bond and leverage loan in the market during that time period as well. But if you go and look, NRC Group closed on time and exactly on the terms that we had outlined with JF Lehman. So if you go and look at that, during a period where every other regular way capital markets transaction failed to consummate, NRCG was able to close. And I think that's a very tangible example of the execution certainty that can be provided by a SPAC if you structure it appropriately. Another benefit, I think, is marketing. It's important to point out that a SPAC merger, which is another way to go public, is legally a merger, not legally an IPO. And that comes with different, effectively follows different rules. And I think that's very important in numerous situations, but more specifically, I think situations are complex transactions where there's a lot more of a story that needs to be told, as well as earlier stage companies where it's very important to be able to outline things like projections, so the company is able to really tell the true story and the true opportunity, where a company that maybe has had 5 years of operating history and being able to put 3 years of audits into the S1 may not be able to tell the full story, particularly for a high stage growth company, much like Canoe, which, as you mentioned before, is going public via HCAC4, and same with Jim and his transaction, which closed with Velodyne LiDAR. Both great companies going through a period of transformational growth. And I think without the ability to fully market the story as required, would not have been ones that investors would have been able to understand as appropriate. The last one is I like to view the SPAC as really a hybrid solution, which combines the best of a private sale, items like ability to monetize a sizable stake if that's relevant, relative speed and less business disruption, price certainty, as in a SPAC, the price is agreed to up front, with all the benefits that you would normally get from an IPO as well. So I really view it as a hybrid solution that kind of takes the best of more traditional monetization alternatives in a private sale and an IPO and kind of combines them into one.
Thanks, Nick. Does anybody have anything to add there?
Yeah, maybe I can provide a couple other illustrations to Nick's points. Our third SPAC did its business combination with William Scotsman, which was a modular space company, these construction site offices that you'll see. And Scotsman was highly leveraged. It had maybe 120 million in EBITDA, but did not have a lot of growth. And there was a competitor, ModSpace, that was in a very similar situation. It made all the sense in the world to combine William Scotsman and ModSpace because we expected $50 to $70 million in synergies over the first year or so. It was very visible synergies. It made a ton of sense to put these two businesses together, but it wasn't really possible to do that any other way. Given the owners, we were owned by a private equity firm. ModSpace was owned by distressed creditors, and the story wasn't sexy enough at the time to do a regular way IPO for either company. Just talking about its standalone business. Private equity guys were lined up around the block, but the owners didn't want to give up any additional equity or any control at that point. Both businesses were highly leveraged, so they couldn't raise any debt. So really the only way to put these companies together was through a SPAC transaction. So we took William Scotsman public, we capitalized it, had a strong balance sheet, and then immediately went about going after the follow-on acquisition with ModSpace. And even though we couldn't promise it and it wasn't in the works and it wasn't definite, most investors understood that we were the most logical buyer for ModSpace. And so they bought into our transaction with the expectation that we were going to do the follow-on deal. In the case of Velodyne that Nick mentioned, it was an early stage company, very similar. The story is very similar to Canoe in that they had contemplated a regular way IPO, but they were at an important inflection point. They had gone through years of of R&D and testing with 300 customers, and they were just now moving into long-term commercial agreements with their customers that weren't really going to hit their stride until 23 or 24. So it's very difficult to do an IPO when you can't talk about projections. With a SPAC, we could talk about 23 and 2023, 2024 projections, guidance. We could talk about these individual contracts, and it gave investors sort of confidence in the future and the valuation that you just couldn't do in a regular way IPO.
That's super interesting. So if I just think about this, I mean, SPACs have been around for like 2 decades, and assuming all these advantages were there all this time, why have they been so much more frequently used recently, and specifically this year? Like what's changed over time? Like why are they so much more in vogue today? And I don't know, Jim, you've been involved in this industry the longest. What do you see from your perspective?
I'm the oldest. I first got involved in SPACs in about 2006 or 7. I was the finance guy at MGM Studios, and we tried putting we were approached by a SPAC, and Nicholas Bergeron and Martin Franklin SPAC back then. I had a 20-year career as a banker. I had never seen such a thing. I'd never heard of a SPAC. And so a very unique experience in first learning about SPACs as a target, where I spent 2 years trying to figure out what the hell this thing was. And SPACs then were a very different animal, and they had been around for a while, but a couple of important things. One, in the olden days, SPACs combined the vote and the redemptions. So if you wanted to redeem, if you wanted to get your cash back, you had to vote against the deal. Second, they were much more highly leveraged on the warrants, in that several SPACs of that era had 1.5 times, like 1.5 warrants per unit in the IPO, and the conversion price might have been $7 or $8. So it was a very different animal at the time. It was very difficult to get deals done. Fast forward about 5 years to 2011, Harry Sloan, Jeff Skansky, and I did our first SPAC, Global Eagle. And the industry, there hadn't been many deals, but we moved from SPAC 1.0 to 2.0. And this was the big bang in the SPAC world, because they decouple, or the vote and the redemptions were decoupled. So you could vote for a deal, and still you could vote against a deal. You could vote for a deal and still redeem, which means you are always going to get 100% vote, because your shareholders also held warrants and they wanted them to have some value. So the whole question about whether you're going to get approval went away, because everybody would vote for the deal, and they may or may not redeem depending on how the share price performed after the announcement. Second, the warrants went from being in the money immediately to being sort of 1-to-1 and an exercise price of $11.50. So the share price had to go up before it was dilutive, and that change in SPAC 2.0 really sort of moved the SPAC industry forward. And since then, there's been a lot of tweaking around the edges, particularly with respect to warrants. In 2011, it was sort of 1-to-1. You got a share and a warrant into a full share. And then a couple of years ago, it got to be warrant into half a share, then a third, then a fourth, then a fifth. And there's some SPACs now that have no warrants whatsoever. So the SPACs have become much less dilutive over the last few years, which makes it more attractive to to fundamental investors than the hedge funds that played it. But the fundamental structure really hasn't changed that much in the last 10 years. I think SPAC sponsors have been talking about this for 10 years. What is SPAC 3.0? We still don't know what that's going to look like. Now, in talking about the evolution real quickly, I mean, I go through a couple of illustrative transactions, that weren't necessarily the precedent setters, but are just sort of examples how things have changed over time. So I don't think, I could be wrong about this, but I think the first major private equity firm that sold an asset into SPAC was TPG sold Nexio to the Wilbur Ross SPAC. And before then, it was almost impossible to get any private equity firm to take you seriously as a SPAC sponsor. When TPG sold their assets, suddenly a SPAC became a viable exit path for major private equity firms. And our discussions accelerated. And Bluebird, yeah. So Nick was there too. So the second example, so it became much more on the radar screen after that transaction. And Hennessy was clearly at the forefront of this as well. Second, the example I mentioned for William Scotsman, where it wasn't just an exit plan, but it was a way for the private equity firm to finance a follow-on acquisition or growth when they couldn't fund it itself. And again, after William Scotsman, we saw a huge wave, and there was, a ton, like $40+ million in banker fees on that transaction as well, because we did a refinancing. So you had, again, a lot more private equity guys going through their portfolios, looking for situations where a SPAC may make sense, and bankers started getting more actively involved. The third sort of illustrative milestone was in Virgin Galactic. That was just, it seems like a lifetime ago, but I think it was just a year ago, where you had a SPAC that took public, basically a startup. It wasn't going to have revenues for years. And that was the first time that a SPAC transaction really got the attention of the retail market. So you had a business plan, with some very prominent people around it. You had retail investors, and I think for the first time you saw the SPAC sponsor put in, $100 or $200 million. So that was really a real milestone for the business. And then probably, March, April, May timeframe, you had the rise of the Robinhood investors. Nikola, DraftKings were deals that had tens, if not hundreds of thousands of retail investors. The price popped to $50 or $90 after closing. And we had never seen retail investors in the market before, with any scale. In fact, in most cases, the SPAC struggled to get the 300 shareholders required by NASDAQ. You always had to scramble to get 3 shares to your friends to top up your shareholder count. And suddenly, after Nikola and DraftKings, you had tens of thousands of retail shareholders, and they had a much different perspective. They were looking at the high growth tech companies much more than the sort of fundamental investors. They were pushing up the share price from $10 to $14, $15, $20 after the announcement of the transaction. So that really changed the way people looked at these SPAC deals when you had tens of thousands of retail investors coming in, taking out the fundamental investors very early in the process. And so the Jim, ability, I'm sorry.
Oh, sorry. No, I just want to make sure I'm and open it up to these other guys too, because yeah. I think you're making a lot of solid points. No, it's super helpful. The because also one of the things that we've seen is sort of in that sort of timeline, 2018 seems to be sort of a defining year. I saw some stats recently that the SPACs that de-SPACed in 2018, collectively had a weighted average share price of about $17. The ones that de-SPACed in 2019 had a weighted average share price of about $24. But if you took all the SPACs that had de-SPACed in the 5 years prior, it was still sub $10. So there was materially different performance as well. And I think that's part of this whole change. I wonder if Nick or Jason, if you guys have something to add to what is fundamentally changed in this evolution. What explains this, recent performance phenomenon?
Yeah, what I think it really comes down to, and I'll explain why in a moment, is I think the SPAC market is finally functioning the way it's supposed to. And what I mean by that is, in theory, the way a SPAC works is a great sponsor finds a great business combination target. They sign an LOI with the company, which is not a public event. They go out, they talk to blue chip, fundamental, long-term investors like you would a regular way IPO to raise a PIPE. Then once the pipe is raised, you announce the transaction. The public market sees the investor presentation, the SEC filings. They see that, that the transaction, the valuation has been effectively, blessed by really well-known institutions like BlackRock, Fidelity, Wellington, T. Rowe, all the big names that you're used to seeing in the IPO. The stock trades up because it was a good transaction. And then you think about the redemption risk at that point, and who's going to redeem for, $10 when, you could sell the share for $12, $13, in some cases $30. So I think that's the way in theory that the SPAC market's supposed to operate. But as with any capital market transaction, everything really comes down to shareholder composition. And I think the reason you did not see what I just described happen before really is defined by shareholder composition. And what I mean by that is, if you go back and look at the earlier days of SPACs, and not talking about the pre-Great Recession SPACs where there was truly a flawed structure, as Jim walked through before, but call it the post-Great Recession SPACs, and going back now 5, 6, 7 years, the investors who were predominantly investing in SPACs were a group called the SPAC Mafia, which was a very small group of hedge funds that was predominantly in it for an arbitrage strategy, where they really had no intention of investing in the ultimate opco. Their goal was to invest in the SPAC, get a free warrant, and then either sell off to somebody else or redeem. And because of that, it was hard to get, it was harder to get SPAC deals done. And I don't think you saw the same type of deals coming to market that you would otherwise, because of the capital uncertainty and some of the risk associated with the structure. And I think a good example of that is maybe our second SPAC business combination. We closed the transaction. It was very successful. We had a lot of significant proceeds from the SPAC trust, but with many SPAC transactions, there were some redemptions. Then you kind of fast forward the tape 6 months. The company went to do a regular way equity offering, a follow-on equity offering to raise primary proceeds. And the follow-on, I believe, is 12 times oversubscribed and at a 20% increase to the equity value of the D-SPAC. So you would say, well, did anything fundamentally change with the business, the market? And it was kind of status quo from when we closed the deal. But the reason it was so oversubscribed, even though it was a higher valuation, I think was purely driven by the fact it was a regular way equity offering as opposed to a D-SPAC. Because I think a lot of the big name investors I mentioned before, they just didn't understand SPACs. They were wary of SPACs. And that's why you saw that result. Now kind of fast forward the tape, and you look at Jim's deal with Veladine, our deal with Canoe. We went out to raise for Canoe. We went out to raise a $200 million pipe. It was meaningfully oversubscribed. We upsized the pipe to 325. It was anchored by blue chip fundamental investors like BlackRock. We announced the transaction, and Canoe was subsequently traded up to $20 a share, which has allowed the long-term investors who want to be a long-term holder of Canoe to get in. And it also allowed the investors who were likely to redeem or who weren't long-term holders to cycle out. So now, and again, it comes down to shareholder composition, because of the fact, if you look at our pipe book, if you look at our shareholder roster, it feels and smells just like a company that went public through a regular way IPO versus maybe what we saw 5 or so years ago. So I think the change in shareholder composition that you've seen today versus SPACs 5 or so years ago is now more reflective of what you would want to see in a company going public. And that's become kind of a self-perpetuating cycle where better investors lead to better deals, better sponsors. And, it's kind of a self-fulfilling feedback loop, which is really impactful.
Thanks, Nick. And Jason, maybe you can touch on this, because I think that this idea with the shareholder composition and sort of the investor base, I'm interested to know kind of how you think about, from a tactical or strategic standpoint, how are you using SPACs in investor portfolios, or how might, investors at or clients of UBS be using SPACs?
Well, it's really interesting hearing, the comments from Nick and Jim sort of describing how the evolution, just thinking about why it's been so big this year. It's clearly, I think, a convolution or confluence of factors that have just matured the sector and the industry. I think it's also helped that just as an IPO market, traditional IPO market, it's the best since 2000. So I don't think that's an independent event. I think there's, the factors that have caused investors to look for growth opportunities in conventional IPOs has helped the SPAC market. But when we looked at the kind of SPACs, I was kind of coming at it also from a little bit of like, well, what is this? How does this function? And as you look at it as an investment, I think it's important to realize that there's a very different risk profile as you evolve from the SPAC from the time of the IPO until sort of the merger is completed. They're almost like two different investment profiles. when you buy at the IPO stage, what you're in some sense almost buying is equivalent to kind of a call option. And you think about what the payoff profile of a call option is, it's, you know, the flat line up to the strike price, and then you kind of get the upside and you pay the premium to get that. And the reason why the payoff profile looks like that is because of this redemption option. You know, you buy shares for $10. If you don't want to, you know, participate once the merger is complete, you can redeem and get your $10 back. So that kind of creates a bit of a floor. But then you also have the upside of the stock actually kind of rallying, you know, upon announcement, or if you have the warrants, you get some of the upside there. But what you're doing when you're buying at the IPO is you don't know what company is going to be purchased. You're essentially making an investment in, you know, people like Jim or Nick to be able to go out, find attractive acquisitions, you know, structure them well, and get that performance. So when we think about it from that perspective, you know, these are not the simplest investments. There's complicated, you know, certainly more complicated governance structures relative to just buying shares in a public company. You know, the payout profile can be a little more complicated because of the warrants. So unless you're relatively sophisticated, you know, we've told our clients, like, don't necessarily participate at the IPO. If you do, though, you think about it, it's almost like you want to buy a portfolio of SPAC investments, because then you're buying a portfolio of ultimately sort of portfolio of companies. Not unlike if you were to invest in a private equity fund that's going to invest ultimately and buy, you know, 10, 15 kind of companies. And if you do it that way, though, given the payoff profile I described, it's a little bit like almost a trading strategy. I think, you know, Nick sort of alluded to, it used to be, you know, maybe the SPAC mafia or kind of a hedge fund that were involved. It's clearly kind of evolving. But as you move from the SPAC profile and the timeline to when a merger is actually announced and then when it's actually completed, well, now really what you're buying is essentially shares in a public company that's sort of newly public. And whether that's through a traditional IPO or SPAC, it's the same kind of linear payoff profile. I think that the important thing, you know, that's kind of evolved in the marketplace, and I think as more investors have got involved, is the PIPE aspect. If you look at the performance of SPACs, you know, during sort of the time from IPO until a merger is announced, the share price basically stays at $10 because there's no real new information. So it's kind of a flat line and looks like that strike price. And then it starts to move higher on the announcement of some sort of acquisition. And then from where it goes from there really depends on the acquired company. Huge divergence in performance, you know, once this merger is complete. But if you get sort of the fundamental investors coming in, like if you look at a SPAC or if there's a PIPE component to it, it tends to differentiate, you know, subsequent performance versus those that don't. So that's kind of how we think about it. Is you're sophisticated, you can buy maybe at the IPO as a diversified portfolio. If you're not, almost you want to wait until the acquisition materializes and then decide, is this a company I want to own? In between the two, there's just not a lot of new information to justify making an acquisition then if you didn't make it at the IPO. And that's kind of how we think about it. They're really two almost distinct different investing points for investors.
That makes sense. And I don't know, do you guys have anything to add? I mean, as a sponsor, or, you know, Nick and Jim, are you guys considering the perspective of an investor and who it may be appropriate for and at what point, or is that sort of not really, you know, in your wheelhouse? Interested to kind of hear your perspective.
I think you always have to think about the perspective of the investor, because ultimately you need to migrate the shares from, as Nick described, kind of the SPAC mafia IPO investors to longer term holders, which could be fundamental investors, multi-strategy firms, and now retail. So, you know, in the current market where there is a lot of retail, you do need to think about, you know, sectors that are attractive to retail, that are generating excitement with retail investors, but you also need to have a story that the fundamental investors like, and that's about having visibility on future performance, you know, to get the fundamental investors to stay. But so one other comment about kind of performance since 2018 and why it seems to be better today than it was historically. You know, part of it is there's just, you know, as the deal certainty has increased, as it's been easier to get PIPE investors, as you have more fundamental investors playing on the back end. I mean, even with William Scotsman 3 years ago, it was very difficult to get fundamental investors to come and play on the back end. Most of them wanted to see a quarter or two performance before they would invest. But we had probably 100 fundamental investor calls over the summer when we never would have had that 2 or 3 years ago. So because you've got fundamental investors coming in before closing, you've got retail, and you've got a much more active PIPE market. There's more certainty of closing. If there's more certainty of closing, you know, the bankers and the private equity firms and the other owners are looking at SPAC as an option. So you're seeing like the average deal size. I don't have the data, but I bet it's doubled in the last 2 or 3 years. Almost every transaction is $1 billion plus, you know, sort of the scale that the fundamental investors are going to want. So there's a much higher quality target. I mean, Nick and I both did good deals years ago, but there's a much more higher quality average target today, because there's more people who have identified a SPAC as the right solution for that situation. And they're using SPACs for more, they're set up for SPAC trades today, rather than before where it was kind of random. Well, I couldn't do an IPO, maybe I'll do a SPAC. Well, I'm not quite ready to sell, maybe I'll do a SPAC. Now people are doing a SPAC because the structure itself helps them achieve their business goals.
Thanks for that.
Hey, Bobby, if I could just to give some context, like the numbers we're talking about, when we looked at it recently in terms of the SPAC acquisition targets, like how big are the companies once the merger is complete, it was about a 5.5 to 6 kind of ratio relative to SPAC size. Meaning if the average SPAC this year was raising $350 million, the company, when it was kind of acquired and listed on exchange, had a market value of like close to $2 billion. So I think that's when you're talking about companies of that size, these are now sizable, kind of credible companies, as opposed to something where you're playing in the space of like only a few $100 billion. So I think that definitely makes a difference as well.
No, thanks for that. I mean, and I, we're talking a lot about pipes, and I wonder, so to a lot of investors who are just sort of getting up to speed on SPACs and, hearing headlines in the news and so on, it's often sort of the IPO shares, side of the equation, but there's a lot more on the back end. If you buy a company that's, enterprise value is 5 times the size of your SPAC, there's other capital that comes to the mix. So maybe you guys could talk a little more about SPACs or about pipes, the role that they play, and other market participants who get involved to make one of these transactions happen. Is there a senior lender? Are they relying on the high yield market? Like, what are some of the other players that are necessary to get the transactions done? And that's just a toss-up. Anybody can take it.
As with everything, I think it depends. It depends on the deal. I mean, when we were looking at more traditional industrial companies, which was the theme for Hennessy 1 through 3, for example, we were working in the leverage finance markets, because these are the kinds of companies that you can appropriate put leverage on. We all come from, or many of us come from, a private equity background. So, this is not leverage at the same level you would see for a traditional buyout. But, in the public markets, despite leverage being more modest for a very mature industrial company, again, using Bluebird as the example, it's a 100-year-old company with a tremendous cash flow profile, providing a very essential product in school buses. So, in that case, there was leverage. In the case of Canoe, earlier stage company in the EV sector, debt is not appropriate for that type of business, or that type of stage in the business, at least. So we didn't. So I think every one of these transactions, depending on the industry you're focused on, the stage of the company, the cash needs. I mean, I would think about it the same way as they would a regular way public company. What's the appropriate capital structure for that company? And I think that's not dependent on whether it's going public through an IPO or a SPAC or an existing public company.
I think that's right. And you also, so we, and I'm sure Nick has looked at, every source of capital through the capital structure, senior, mezz debt, converts, equity, warrants. I think one of the advantages of SPAC is that it's very flexible, and you can set up, and you've got 3 months to market this. You've got some time, and you can set up the most appropriate capital structure for that transaction, as well as set it up for the future.
Okay, thanks. I want to be cognizant of time. We want to leave a good amount of time for Q&A, but I think one of the most important topics to kind of hit on before we transition into Q&A is just hearing, what everyone's expectations are, for the future of SPACs. And I think, obviously, we look at, there were more than 200 SPACs outstanding right now, searching for targets. I think SPACs raised over 70 billion this year. It seems like there's going to be a lot of competition. And historically, we saw pretty high rates at which SPACs were able to consummate, business combinations. What's that going to look like going forward? Is there going to be a lot of broken SPACs, failed SPACs that don't find business combinations? or is this just going to replace regular way IPOs? Like where is sort of, your views of where the SPAC sits in our capital markets?
My view is we'll see both things. One, we'll see more SPAC transactions than ever before because more companies are looking at SPACs. It used to be that there were 3 bankers at each of the major firms thinking about SPACs. Now there's 100 bankers at each of the major firms looking at SPACs. It used to be that nobody knew, so people are looking through their clients' portfolios. There are going to be much more deals. So I think there's going to be a ton of deals. I don't think the deal flow is the problem. I think pipes are the bottleneck because while there may be sort of unlimited deals and unlimited back end capital markets appetite for these, I think the spigot gets cramped at the pipe level. So you'll see deals that may not have a pipe on the back end. So I think you're going to see a ton of deals, but I also think that we're going to see a huge number of broken SPACs. I think there'll be 300 SPACs sometime next year, and I would bet that 50 of them aren't going to close with a business combination. That still means 250 will.
Gotcha.
I'll add a few maybe points from my perspective. If this was the year of the SPAC IPO, I think next year is the year of the SPAC acquisition. So I think there's 200 companies with 60 billion that can be kind of levered up, or at least with pipes, to have a lot of dry powder to do acquisitions next year. So I think Jim's point is a lot probably won't be successful. So I think that'll be more of the narrative next year. I do worry a little bit about if there's a lot of money chasing fewer deals, the problem is then you kind of have the risk of overpaying, which ultimately leads to sort of poor returns for public equity investors longer term, and that applies not just to SPACs, that's true for conventional IPOs. So that's a little bit of a risk I'd have for next year. But then just sort of taking a step back from that, the way I think of it is how do companies go public? We have a very traditional approach that it's worked well, but it has certain limitations and flaws. So I think the development of SPACs just expands the toolkit for companies that are thinking about going public, or for investors who want to access these kind of growth companies. That's a positive, a net, because maybe companies that wouldn't have been able to do it before now can. I think Jim gave a really good example earlier of 2 different companies that couldn't kind of exit either way, but the SPAC was a good opportunity for them. So I think ultimately that sort of expands the set of companies that could be doing this. I don't think SPACs will be replacing conventional IPOs unless SPACs get really big. They're just not going to be big enough to do, take a company like Airbnb public, given its valuation, justifiable or not, was, $100 billion, on its first trading day. But I think just the bigger thing that I think any company going public, whatever your process is, the challenge sometimes is, figuring out sort of price discovery, and Nick made a comment earlier that one of the strong advantages of SPACs is the certainty, both deal certainty and price certainty. And that's true for the terms, but once it starts trading, sort of figuring out what is the value of these companies once they start trading is not easy. There's been criticism, obviously, leveled at some of the bankers last week for the pricing of, Airbnb and DoorDash because their prices jump so much. This has been a sort of a long-standing issue for a number of years of the conventional approach. I think the reality, though, is figuring out what is a fair market price, and sort of price discovery is challenging, whether it's the standard IPO process, whether it's SPAC, or whether it's a direct listing. I think each has their pros and cons, and I think just depending on the situation, some have merits versus others. So I view them as kind of complementary tools for bankers, for companies, for investors to go public. I think ultimately that's kind of positive near term, or long term. Just I think over the next year there could be a little bit of kind of growing pains as everyone sort of figures out what is the right process, and kind of we reach sort of an equilibrium of a balance between the different options.
Thanks, Jason. Nick, what are your thoughts? Future of SPACs? Hennessy 5, 6, 7.
Yeah, so look, I'm going to echo many of the points that you already heard from Jim and Jason. Look, I think competition for quality assets is certainly going to be greater, given the abundance of SPACs. But again, as Jim alluded to, I think the counter to that is that the broader acceptance of SPACs amongst businesses and business owners, and the success of recent transactions has really increased the size of the overall pie. So while competition has gone up, I think that's actually more than offset by the increase in acceptance of the asset class. And now, and again, some of this Jim said before, I don't think I've seen a banker pitch book when they're going through strategic alternatives where the SPAC is not something being considered. Even go back 2 years from now, I'd be shocked if you saw them in 5% or 10% of pitch books around potential strategic alternatives for companies and their owners. And I think if you really go back to Hennessy 1 through 3, we jokingly like to said we were going out on when we were taking our sourcing efforts, we called it our missionary work. And what I meant by that is we spent almost all of our time talking to intermediaries like investment bankers, asset owners like private equity firms, hedge funds, and other types of business owners, really showing up and just telling them what is a SPAC and what are their benefits. I don't think if you look at any of our prior transactions before Canoe, when we met with the owners, the SPAC was something that they were already contemplating. They weren't really contemplating it until because they didn't really understand what it was. And then once they heard what it was and some of the benefits, that's when they just started to think about, oh, could this be right for us? And then ultimately transpired in a transaction. So if you think about the efficacy of our sourcing efforts, we spend most of our time teaching, and I think probably of the meetings we had, maybe only 5% would result in kind of further deliberations around the SPAC for that particular company. Now, given again the success you've seen in many of the recent transactions, the execution certainty has gone up meaningfully in many of these recent transactions. Now, where I'm spending my time is when companies have come to us and said, we want to go public with this SPAC and we want to talk to you about it. So the efficacy of our sourcing efforts has gone through the roof. So while I think the increased competition is more than offset by the actionability and the size of the overall opportunity set, I would echo that the SPAC market cannot continue at this pace. I think the SPAC market will be here to stay for a long time, but not probably even close to the levels that we've seen over the last 6 or so months.
I agree with everything Nick said. I mean, I think Hennessy and Dan and Nick and I have spent the last 8 to 10 years in the wilderness evangelizing SPACs, and so you're welcome, market. We've been prospecting for years, but I would sort of challenge one of Jason's comments about bidding the price up. Unless we competed with in a number of SPAC offs. We competed against Nick in a number of SPAC offs, but we never found valuation to be a deciding factor in any of those situations, because it may have been years ago if there were competition, but there wasn't. But I think the advisors are experienced enough these days that they know the market's going to decide. If I say it's a $3 billion valuation and Nick says it's 2, I'm not going to win, because the bankers will call bullshit. They know that it's the market really sets the prices. So I'm not worried about these SPAC deals getting overpriced. I think the real challenge is figuring out in price discovery. We do so much price discovery, but there's no way to do price discovery with the retail market other than leaking a potential transaction, which we don't do.
So Jim, actually just want to follow quick on that. I mean, given the SPAC structure where you have 2 years to do an acquisition, what about the possibility that there's some people where the clock is ticking? If they don't do an acquisition, they have to kind of give back. Do you think that creates an incentive to overbid? Like, how worried would you be about that?
No, because you can't get it done. I mean, at the end of the day, you can't, I'm not deciding to overpay. I can't pay any more than Nick can. I can give up more founder shares, but the ultimate market value, we can argue around the fringes whether, we've got better access to certain investors and more credibility, but there's no way I'm going to value something at $2 billion and Nick's going to value it at $3 billion and win. The market's the market.
Yeah, to Jim's point, I mean, if you go to our transaction with Canoe, the owners had spoken to a few different SPACs. They said we were the lowest bidder by far, and they chose us. And the reason they chose us is because they realized that we had what was best for the company and for their shareholders in mind by coming out with a valuation that we thought would clear the market and trade well with a reasonably high probability, versus putting out some number that was egregious to try to win the deal and then have to backtrack it when the market ultimately walks down the road.
Well, guys, this is awesome. We have a number of questions from the audience. I thought maybe we would transition into some of these. So one question that comes up, which I think is pretty relevant, because we talk about some of the benefits of the IPO or of a SPAC over a regular way IPO, is that you can talk about your target's future. You can put sort of forward-looking statements into the mix, whereas you can't with a regular way IPO. I mean, do you anticipate that there may be additional regulations that prevent SPACs from being able to do that? Or any other regulations that may govern SPACs that don't currently exist?
I do worry about increased regulation. Again, I have to keep going back to retail, but that's such a recent and transformative development in the SPAC market. If you've got hundreds of thousands of retail investors and you do see these stocks going to $30, $40, $50, $80, and then crashing back down to 20. And even if the disclosure is appropriate, fulsome, everything required, nothing wrong with the disclosure, I do have some concern that if there are more situations where there are massive retail losses, the SEC may take a look at it. I don't know what they would do, but I do know that is an increasing issue and concern.
Anyone else thought about that, Nick? Is that a concern or relevant factor as you kind of look at the future of SPACs?
I don't know if I use the term concern, but one thing I focus on is in the end of the day, there's two ways to make the one easy way to make your stock go up is to always do what you say you're going to do. I mean, if you look at companies that consistently provide guidance and miss it, that's reflected in their trading price and their multiple. And then you look at companies that consistently underpromise and overdeliver and reasonable guidance. Jason would probably know this better than me. They typically trade at premium multiples. So I think you can put out projections out there which are egregious. And candidly, I can think of quite a handful of ones that I've seen recently where I quite question them. But there's only so long that can help you. Eventually, there's going to be a reckoning where you're held to what you put out there, and you're going to really wish you put something out there. I mean, when we talk to companies that we're talking about this SPAC, we say, "What's your budget for the year?" And then we slash that. That's the number we want to go out with our public market guidance, because we don't want to assume everything has to go right to hit our numbers. We want to have enough cushion such that if certain things don't work out the way we think they are, which is always a possibility, that we're still going to hit our numbers. So, I think there's groups out there that do it responsibly and provide the right kind of guidance that you would want as a newly public company. And there's some that, probably assume everything goes right and then some. But, ultimately, when you overpromise and underdeliver, or the other way around, that's going to be reflected in your stock price. And,
That makes sense. Makes sense.
Yeah, and I agree that's not going to go on for a long time, a quarter or two, or at least within the first year. And as these new deals start getting research coverage, they're going to take a much sharper pencil to your projections. So this is not something that a company can continue for years and years and miss numbers.
And so then, piggybacking on your comment, Jim, about some concern with the retail investors getting involved in the scale at which they've become involved. So we have some questions here about, does the Robinhood investors chasing SPACs like Nikola and DraftKings, does it reflect a bubble, and is it potentially dangerous? I mean, as we look at some of these, that have gone up to 80 and come back down and so on, is this reflective? Is the mania around SPACs and even subsequent price hikes, after de-SPACing, is it reflective of a bubble in some sense? And do you guys have any concerns around that? Or maybe concern isn't the right word, but what are some thoughts?
I would say I'm not concerned about retail investors. The comment was, I think because these prices have been very volatile and it affects retail investors, I think there's a risk the SEC may try to figure out how to address that. I think it remains to be seen. There are some expensive stocks out there. Look at Tesla, and it remains to be seen whether some of these high-flying, recent SPAC deals are just, a lot of them are early stage, are Velodyne and Canoe, and a lot of these early stage companies, may just be, high-priced companies, and they may stay that way. But I don't know yet.
I would add, Bobby, that I think the issue with retail investors is not unique at all to SPACs. I think they apply to conventional IPOs. I mean, the issue of sort of finding a fair value and issuance price, is a challenge. I think the example that Nick gave, where they were the lower bidder and the company actually went with them, because sometimes you want to find stable long-term investors. I think the same idea in the IPO process. Ideally, you find a price that is going to attract stable long-term investors. The problem is once it starts trading, well, you have no real control, and you get say, let's call it the Robinhood crowd, who comes in and is willing to pay far more above it. When there's small float, it's difficult to short. You get the most optimistic investors, speculative investors, kind of bidding up the price. And we've already seen Airbnb, it's down 15% in 2 days from its from where it closed. I mean, that's not kind of creates volatility. But that applies to IPOs and also applies to conventional, already existing kind of tech stocks. So I think the best you can do is, again, you manage expectations as an investor, give the guidance, and then obviously try and outperform, overperform, and sort of underpromise as opposed to the opposite. I think ultimately that will take care of itself. You don't want to do the other and kind of succumb to this is what you're worth because this is what a bunch of investors who might be gone in 2 days, think, and that's kind of the worst possible outcome for the company.
Thanks. Hey, Jason, there's been some other questions here, and I don't know what the policy is, but some of the registered attendees have asked whether they can receive a copy of the paper that you and your group published. I'm not sure what your policy is around that.
So I think it's public, so I think it usually can be made available to clients. I mean, we can talk about this offline in terms of the best way to perhaps make it available, just so we don't kind of violate any regulations on our side as well, because we all know that that can be a problem sometimes.
Okay. Here's one. It's a question about whether or not. So, does a SPAC buy 100% of a company, or can it just buy part of it? Does it? And is the SPAC relationship 1-to-1? Can a SPAC buy multiple companies? I think Jim addressed that a little bit in talking about, combining multiple companies within a SPAC, but can a SPAC buy multiple companies and have multiple public listings? Is that possible?
You can't have multiple public listings, but you can close multiple deals. We've done that twice. We first SPAC bought a U.S. company and a majority stake in a German listed company. And then Platinum Eagle bought 2 companies simultaneously. William Scotsman bought one company, but there was an expectation that there'd be a follow-on deal. So you can do it, but it's got to be part of one transaction, one listed company. Nobody's done the SPAC that can sort of hive off or spin off businesses and continue yet.
Yeah, I think the key thing to note there is it's not a portfolio approach. So it's not like investing in a private equity firm that's going to go out and buy 15 different platforms, all of which would do add-on acquisition. If you're buying more than one company, it's typically 2 companies that are highly synergistic together, that are going to come together and create effectively one company. So you can buy more than one, but it's not a portfolio of companies. It's much more strategic than that.
Gotcha. What about another one that's popping up is the cost to IPO via a SPAC versus a regular or traditional way IPO. What's the cost differential?
We usually like to argue it's more cost effective to do an IPO. That's an analysis you'll always do. You argue that the back end deferred underwriting compensation for a SPAC is 3.5%. That's going to be less than an IPO fee, but you do have an M&A fee to add in. Typically when we've done the math, it's been more. It's required less capital to do a SPAC than a regular way IPO.
It's an analysis of the pros and cons. I think as with everything. I think there's numerous benefits to going public through a SPAC. We spent some time talking about that today. The flip side of that is more expensive. So if you're a situation where the benefits far outweigh the incremental cost, it's a really interesting alternative. And if you're not getting that much benefit from the SPAC structure, then there's no reason to do it. We've always said if the regular way IPO is your, is kind of down the fairway for your company, more likely than not, the SPAC is not the right answer because it's expensive from a dilution perspective and from a cash fees and expensive perspective.
Yeah, I would say, to be clear, it's cheaper on a cash perspective, but a SPAC is often more expensive overall with the warrant dilution.
Gotcha. And warrant dilution, and then maybe touching on sponsor dilution or sponsor economics. That's been worded in a number of different ways here in the questions that have been posed. How do the sponsor economics typically work? And I know they may start one way, and then as you guys go through the transaction, you're giving up sponsor economics. But not even speaking maybe about one of your deals specifically, just more generally, how does sponsor economics work? Anyone?
Well, typically the sponsor will have founder shares equal to 25% of the SPAC's shares outstanding. So a 50 million share SPAC, somebody raised $500 million, that'd be 12.5 million founder shares, representing 20% of the expanded capital. That is something that's negotiated as part of the transaction. Sometimes sponsors, if it's a larger transaction and you're issuing a lot of shares and that full amount gets diluted down or you're adding particular value, you'll keep all the founder shares. More often than not, however, there's some negotiated haircut on the founder shares that you're allowed to keep, or you may have to transfer founder shares to the sellers or other parties. So it's a long way of saying founder shares at the end of the day are negotiated. I think, and you are seeing that in most transactions, the founder shares are sort of 5% of the total outstanding shares at closing or less.
So not just the float, but total outstanding. So 5% of enterprise value, is that?
Of equity value.
Of equity value, but it sounds like in these more recent transactions, there's no debt, so it's all equity value.
Right.
Okay.
So you're seeing some deals where it's 2 or 3%.
And that's why it's so important. As you heard Jim say, the average transaction size has gone up significantly. I'd say that the dilution, the founder promote, the warrants. I mean, that's the reason why it's so important. I mean, if you go and look at a recent SPAC transaction, I think it was a $400 or $500 million SPAC that did a $17 billion transaction. If you look at the structural dilution in the context of a deal that size, it doesn't really have a very big impact. Whereas if you're looking for a deal that's closer to a 1-to-1 ratio to the SPAC, the dilution would be so high that it's just not manageable. So I think that's why it's really important that you're seeing transaction sizes go up relative to the SPAC. So dilution isn't, overly impactful, to the pro forma company.
And also, you don't have the founder. You typically don't have the founder shares or the warrants attached to a pipe. So you can have a $250 million SPAC and a $500 million pipe, and there's no there's no incremental dilution on the pipe.
And what beneficial economics do the pipe investors get relative to the IPO investors?
The difference, I think most of these pipes today we see are done at $10. So the difference between the IPO investors is they don't fund until closing of the business combination, but they also don't get any warrants.
And are there governance mechanisms that if the pipe price is well below the IPO price, that IPO shareholders are protected?
Yes.
Go through Crescent terms, Nick?
Yeah, so I think the Crescent term is the mechanism that you mentioned, whereas if the pipe is struck at the price that's, I think, below 920, again, all SPACs are done at 10, there's a repricing of the warrants, but I don't think you will ever see that happen anymore because that would be so dilutive, no one would ever do a deal like that. So it just means the deal is fundamentally mispriced and you would either have to reprice the deal or move on to the next one. But if you go and look at the benefits of, what does the investor get out of the pipe, I think the biggest thing is a guarantee position or allocation and price. I mean, if you go and look at an investor who wants to put $50 million, into a pipe, and the SPAC is $300 million, I mean, that's such a high percent of the SPAC's overall float. It would be nearly impossible for that investor to be able to buy those shares in the open market at any price close to $10 a share, if they could even get to that kind of position at all. So I think the biggest thing about the pipe, as Jim said, they're all done at $10 a share, which is the IPO price. But by coming in via the pipe, you're guaranteed a position in line with what you want at a $10 price point versus being, versus having to get to the open market and either not getting the position you want or getting a meaningfully higher price than $10.
Okay, thanks. This is a question of risk, and I know after the business combination, the stock has a lot of risk. The risk, a linear risk of any stock, but pre-business combination, when cash is just sitting in trust, we had the question: has there ever been a situation where the cash in trust has been diluted or not been available to really fully repay redemptions?
Not in the modern era. There are stories about that happening years ago when you didn't have to deposit all of the proceeds in T-bills. So there was a risk of losing principal, but I'm not aware. 100% of the IPO proceeds need to go into essentially T-bills or T-bill money markets. So nobody's lost principal.
And is the entity completely bankruptcy remote? Or is there some counterparty risk like at the custodian? So say that sits with, Bank XYZ, and Bank XYZ goes down. Is that money protected?
Well, again, like in our case, all of the cash went to actual T-bills. So we didn't,
okay.
And it was, in a deposit at JP Morgan. So if you're worried about JP Morgan and T-bills, I think you've got other problems.
And importantly, any counterparty to a legal agreement with the SPAC is required to sign a waiver of claims against the trust account. So that way you don't have to worry about anyone kind of effectively suing based on the breach of some kind of agreement and seeking recourse against the SPAC trust. So it really is protected.
Gotcha.
That's an important point. We can't sign, any NDA, any agreement without the counterparty waiving any claim to the trust whatsoever.
Gotcha. I'm just going through some of these other ones that may be relevant. Is it common for a SPAC to acquire a subsidiary of a public company or do a carve out? Is that fertile ground for looking for acquisition targets, or has that not commonly been something SPACs have done?
I can only think of one. Maybe Jim, you could think of another, but only one that's ever been a corporate carve out. And I think the reason for that is it's public company readiness is typically an issue for carve outs. Both actual public company readiness, ready to be a standalone business, but then even just from the technical perspective, it takes a long time, a lot of effort, and a lot of expense to prepare carve out financials. So, unless this is, the actual carving out of the segment has already taken place and the segment was prepared for sale, I think that is the only instance where it would even be feasible for a SPAC to consider that. And hence why I think, because of the time, expense, complexities, and just general preparedness of these companies to be standalone public companies, it hasn't been too much of a ripe area for SPACs.
Yeah, I agree. We have spent a lot of time chasing subsidiary spinoffs and haven't had any success in that area for the reasons.
And company preparedness, I know this is like a big driver too on whether or not a target company is even a candidate to be taken public with a SPAC. I mean, how prepared does that company have to be?
Well, you need to have, this is an issue for all companies. You need to have SEC compliant financials and a separate management team. But I think the other issues that corporates have in a spinoff is, it's got to be accretive And there are other ways to accomplish this. They can just spin off a subsidiary and raise money in connection with that. Or, the type of conversation we most often have with these spin-off deals is, say, the parent company has some fast-growing subsidiary that should trade at a much higher multiple. Well, they can just spin that off themselves without a SPAC. There is some interest if you talk about, well, let's do a merger between that fast-growing subsidiary and somebody else that's going to take several $100 million of cash to make that happen. And the parent company doesn't want to put the cash in because it's not really a core business. So maybe something makes sense, but we've just found it to be very complicated to deal with another public company.
Okay, a question on PIPE financing, and maybe we'll do a couple more and then wrap it up. And but on PIPE financing, so what are the typical categories of use for it? Is it all operational capital, or does some of this go to the seller? Like, what's the typical use of the PIPE?
As with any IPO, there's going to be primary and secondary proceeds, as the company and its owners kind of see fit. Maybe look at our first transaction, which I mentioned, which was Bluebird, which was owned by the private equity firm Cerberus. The entire use of proceeds, inclusive of the PIPE, was secondary. So Cerberus was taking cash off the table, yet they still maintained over 50% ownership in the now public Bluebird, and did that because they wanted to share in the upside that they saw in the company along with the new public shareholders. In the case of Canoe, it's all growth capital. So we raised a $325 million PIPE, plus we have 300 in trust. So that'd be $625 million in gross cash proceeds to the company's balance sheet, and somewhere in between, primary up to the point where the company needs it, and then secondary after that. So I think it could be, as with an IPO, any flavor of primary and secondary.
As you see more and more of these deals and sort of growth tech stories, you're seeing more and more primary equity than secondary.
Gotcha. Let's see. There's been a couple of questions. I know, Jason, you addressed risk, but maybe just to kind of wrap up, as investors are thinking about investing in SPACs, could you just kind of highlight once again where the risks are and how that changes over time?
I think, when you're buying, at the IPO stage or early on, like when the company is kind of pre-merger, you're really at that point in time, unclear what the final outcome would be. So there is an issue of, the SPAC buying a company that you may not want to agree with. Given the redemption rates, some of the protections, I think the downside there is relatively, modest, which is why, for sophisticated investors, it's actually not necessarily a bad idea if they can get into the IPO. Although it's kind of, you have to meet, I think, a certain level of threshold of sophistication. Once you move past that, I guess the concern would be, some of the dilution potential. So like what you're buying ultimately could be diluted significantly if there's a lot of other capital raised. I know there's been some issues in terms of whether the warrants are being repriced or some kind of repricing of terms sort of ex post. I think that's probably not that common, but it is a bit of risk that, the terms that you agreed to initially, aren't fully kind of realized. But then once it goes public, it's really now you're buying a stock that in many cases it's high growth, still somewhat speculative, especially if it's smaller. And we've seen, if you just look at the performance, even over the past year or two of SPACs, post-merger, once the merger is complete, the subsequent returns relative to the S&P 500 on average are below average. Like they're underperforming the S&P 500 by about 15%. Big variation, some vastly outperform, some underperform. This is also not that different from a typical IPO. Like once you get past the first day return, if you look at subsequent price performance over the next 6-12 months or even over a couple of years, a lot of them underperform. And this is a historical pattern for IPOs. And that's true of any new public company. You have an element of investors thinking a bit of a lottery ticket. This is the next big thing. So it tends to get overpriced. Some end up being very, very successful. They're the next Tesla. But a lot of companies, don't become that. And so I think just that's true of any sort of smaller public company. That's a risk that you have to be aware of. That tends to be an asymmetric payoff. A few small winners. A lot of those companies that don't end up really kind of being that successful, long term.
And then, okay, one final one that's come up a couple times here is tax events. So just are there tax events over the course of holding a SPAC share? So is a business combination create a taxable event?
It shouldn't be.
I don't think that it is, but I don't know.
I mean, typically you want to structure these as tax-free events.
All right. Well, listen, guys, I think, you know, we're running about 15 minutes over. Really, really appreciate your time. So just on behalf of everyone, thank you to Jason, Jim, and Nick for joining us this afternoon, and also for everybody that attended the event today. As a reminder, the replay of the event will be posted on the Society's website and YouTube channel. If you have any questions about today's event or would like to help plan future Society events, please contact the CFA Society of Chicago office at info@cfachicago.org. Again, thanks everyone. Appreciate your time, and hope we're all better for it. So.